Welcome, Focus learners. Let's jump right into this explainer. Today, we're targeting a giant in the passive income world, Realty Income. Known to many simply by its ticker symbol, O. For years, this company has been the undisputed king of net lease REITs, and it's marketed heavily as the ultimate set-it-and-forget-it, sleep-well-at-night dividend stock. But today, our goal is to strip away all that mainstream marketing fluff. We're going to examine the underlying structural realities of this $50 billion behemoth. We're looking strictly at the numbers, the balance sheet, and the actual economics that the talking heads on TV just gloss right over.
Okay, let's dive into this. 667. Now, you might be wondering, what is that? That is the staggering number of straight, consecutive monthly dividends Realty Income has paid out. It's a streak of over 30 years of consistent raises. And honestly, it's incredibly easy to hear that number and feel a profound sense of safety. But here's the thing. This massive streak is exactly what creates this illusion of invulnerability. The dividend is safe, for now, sure. But as you'll see in a minute, the economics underneath this company are starting to rot.
Here is our agenda for this explainer. First up, the 5 hidden red flags. Second, the operational moat. Third, the Graham and Lynch verdicts. Fourth, the Warren Buffett test. And finally, the final verdict and strategy. We are going to systematically stress test this giant using the strictest valuation gauntlets on Wall Street so you don't miss a single crucial detail.
Section 1. The 5 Hidden Red Flags.
Let's break down red flag number 1, which is a complete capital efficiency collapse. Now, every mainstream analyst loves to praise Realty Income's 99% occupancy rate, right? And on the surface, that sounds absolutely flawless, but what they are completely ignoring is the massive cost required to maintain it. Over the last 5 years, their total assets grew by a whopping 25.7% annually. You'd think that would lead to a massive boost in income, wouldn't you? But revenue only grew by 6.1%. Think about that. For every single dollar they are pouring into buying new properties, they are yielding aggressively diminishing returns. They're getting much bigger, for sure, but their capital allocation is getting vastly less efficient.
Moving to red flag number 2, we look at the Altman Z-score. This is a classic financial metric used to predict the probability of bankruptcy. Realty Income currently scores between 0.99 and 1.1. Now, to be fair, real estate investment trusts do traditionally score lower here because of their specific business model. However, sitting firmly in the traditional distress zone is a stark warning. It literally means that if we were to hit a severe credit crunch in the broader economy, this balance sheet is highly vulnerable.
And this brilliantly illustrates red flag number 3, their massive debt stack. Get this, Realty Income is carrying nearly $30 billion in total debt, pushing their debt to equity over 70%. Let's look closely at their earnings breakdown. They generate $2.7 billion in total earnings before interest and taxes. Sounds great, except they are paying $1.17 billion just to service their interest. That leaves them with an interest coverage ratio of only 2.3 times. When you are paying that much just to keep the lights on with your lenders, it severely eats into the cash available to actually fund those beloved monthly dividends if interest rates remain high.
Okay, red flag number 4 exposes what we call phantom earnings. If you glanced at the headlines for Q1 2026, you probably saw an 11% revenue beat. But contrast that with their actual GAAP earnings per share, which completely missed expectations by 17.5%. How does a mismatch like that happen? Well, actually, that massive revenue beat was padded by $40 million in one-time lease termination fees. Management even admitted this was non-recurring. Essentially, they juiced the headline numbers with one-off checks that are going to completely disappear next quarter.
Finally, red flag number 5. Insiders are bailing. Over a recent 3-month period, looking at the stock priced at $61 a share, there were 2 distinct insider sales and absolutely 0 insider buys. This is a simple but incredibly powerful tell. Let's be real, if the CEO or the board truly believed the stock was a screaming steal at $61, they'd be buying it hand over fist. The fact that they aren't tells you everything you need to know about internal confidence at this price level.
So, to quickly summarize these 5 hidden red flags before we shift gears, we've got a capital efficiency collapse where asset growth is vastly outpacing revenue, a Z-score flashing distress, a $30 billion debt stack eating up earnings, phantom revenue beats built on one-time fees, and insiders who refuse to buy at current prices. This is the complete picture of the financial cracks that the mainstream narrative completely misses.
Section 2. The operational moat.
Now, to be completely objective, with this explainer, we absolutely must look at the counter-argument and give credit to their undeniable operational strengths. There is a reason Realty Income is the 800-pound gorilla of the net lease space. Just look at the sheer scale of this operation: 15,500 properties spanning across 1,600 different tenants, alongside an aggressive and successful expansion into Europe. Plus, they have a massively powerful relationship-driven operational moat. A staggering 94% of their transactions aren't just auctioned off to the highest bidder, they are secured through private network deals. When a major retail chain wants to do a $500 million sale-leaseback, they call Realty Income. The operational moat is incredibly wide. But, as we just saw, a wide operational moat simply doesn't matter if the financial moat is drowning in a sea of debt.
Section 3. Graham and Lynch Verdicts.
It is time to run these operational and financial realities through the ultimate valuation gauntlet, starting with two of the most legendary investors in history. First up, Benjamin Graham, the father of value investing. Graham's hard rule was never to pay more than 15 times earnings. Well, Realty Income trades at a PE ratio of roughly 50. Using Graham's intrinsic value formula based on GAAP earnings, the fair value lands at exactly $41. At the current $61 price tag, that leaves zero margin of safety. His verdict? A hard reject. Then we have Peter Lynch, the champion of growth at a reasonable price. Lynch wants a PEG ratio of 1. With historical earnings growth of about 30%, but a PEG ratio currently pushing 5, Lynch's fair value sits way down at $30 a share. He would absolutely run for the hills to avoid overpaying for this kind of growth. His verdict? Severely overvalued.
Section 4. The Warren Buffett Test.
The final and most critical judge is the Oracle of Omaha himself. Now, on the surface, Realty Income offers a 7% owner earnings yield, which easily beats the 10-year Treasury and might initially look appealing to Buffett. But there is a massive deal breaker lurking just beneath the surface: 0.3%. I really want that to sink in for a second. This number represents the return on invested capital, or ROIC. For Warren Buffett, this is the absolute #1 metric for a successful business. He wants to see a company that can take its profits and reinvest them at high compounding rates. Realty Income is pulling in a microscopic 0.3%.
As Warren Buffett famously states, if you have a business with a 20% ROIC, time is your friend. If it's 5%, time is your enemy. Think about that. Buffett says at 5%, time is your enemy. At 0.3%, time is a completely hostile force. Realty Income is actively destroying value with their reinvestments compared to their cost of capital.
So when we put it all together on the scorecard, the stock receives a Buffett Fit score of just 42 out of 100. This is categorized as a weak fit. And the nail in the coffin? Buffett heavily despises excessive leverage, and Realty Income's net debt to EBITDA ITA is sitting uncomfortably at over 7 times. Buffett's final stance is a hard avoid.
Section 5. Final Verdict and Strategy. So the crucial point is, what does all this actually mean for you, the retail investor? Realty Income at $61 presents a true paradox. The market right now is pricing the stock like it's a high-growth tech company, completely ignoring the fact that it is actually a slow-growth, highly leveraged landlord. Here is where the math finally makes sense. For current owners, you hold it for that steady dividend, but you absolutely must understand the rising structural risks we just outlined. But for buyers looking to deploy fresh capital, you wait for the buy zone at $45. That is where you finally achieve a true value investor's margin of safety.
To wrap up this explainer, the biggest takeaway is this: do not get hypnotized by that 667-month dividend streak. A fantastic past does not guarantee a safe future, especially when a balance sheet is this stretched and capital efficiency is collapsing. So I'll leave you with this final question to spark your own ongoing analysis. Looking at the underlying math, is Realty Income a buy for you at $61, or are you waiting for the dip? Keep learning, keep analyzing, and we'll see you next time.